Okay, good evening, everyone. So here's where we left off, right? So I'm using the PowerPoint slide that we have. You can find it on Canvas. So it's investment A and investment B. So we actually went through three. Actually, we have the fourth one, the MIRR, right? So you can recover faster on investment A, 2 years, compared to 3.8 years in investment B. So quicker payback is investment A. The net present value, dollar amount, or the increase in wealth of the shareholder is 180. So after 3 years, because by the third year you would actually get the money, right? This one after 5 years is estimated to be 1.40, 1,414 out of the $10,000 that you invest. So the higher net present value is investment B. And the internal rate of return is now, this one is higher, investment B, by 14.33 compared to 11.16. So how do you actually value it? So there are different school of thoughts on how things are being valued. A lot would say net present value would be something that you would want to consider. It's either between a toss-up on the net present value or the IRR. I would say that depending on the type of company that you have. So I work for a company that's not publicly listed. Um, we normally use the IRR, right? We don't use the MIRR, but we use the IRR for our calculation because your calculation that you get is dependent, is only as good as the amount of effort that you included on doing the assumptions or even using the proper weighted average cost of capital. We use 10% here, right? Was it proper or not, depending on. So we look at it both on the net present value and the IRR, but we look at, hey, anything above 10%, which is our discount rate, in this case, I would say that this will be a good business. And then rightfully so, because you would, oh, sorry, rightfully so, because you would see a 1,414 as a net present value. Okay. So we're going to go through some of the other topics within the book, the selection of strategies. So there's a discussion on mutually exclusive, right? So mutually exclusive project, I'll go back here to our prior page, would mean that one is not dependent on the other, and then that mutually exclusive, that you're going to be using different assets and whatnot, right? Like different assets to use, different people, different technology, or might be the same technology, but it's not going to be using the other resource. So you can independently look at it. So if it's mutually exclusive and then you only have 10,000, I would take a look at it as investment B. But if it's mutually dependent, this one is dependent on this, then that becomes more of a qualitative type of discussion that needs to be included, right? Regardless, investment decision making should be both on the quantitative side, our calculation, and qualitative side. What's the business risk? What's the legal and tax compliance risk? Financial risk? What are operational risks? So those are things that needs to be considered before saying that, hey, I would fully do a business plan for investment B. Okay. Now I have here, this is the example that we're talking about on the IRR, right? On the MIRR. You are expecting on this calculation of IRR that the amount of cash flow, the in cash inflow, will be reinvested at the IRR level, which is not the same or not the case because I might get on investment B on year number 4. I get 5,000, just in case that our assumption is almost good forecasting. On year 4, I realize the 5,000. Economy is bad. Hey, do I have an amount to invest it at the 14.33 as computed as the IR? More likely not, depending on, might be higher, might be lower. So we need to recalibrate that IRR calculation because she would not just realize it. Why not peg it to the cost of capital just to be on the safe side? That's where the MIRR comes in as a formula, which is the one that we actually calculated. It's basically the rate and then or the cash flow and the MIR plus the rate that we have at 10%, right? So that's actually our calculation. I'm gonna go here. Actually, our MIR we use equals MIRR, then the rate, then the cash flow, and then from sorry, the cash flow, and then after the cash flow, we actually did the 10% for both, right? So that's actually our calculation. So here they actually use the rate formula. So in a way, um, don't worry too much because the quiz is not going through the MIR or the more complicated. But we would like I would like to make sure that you understand where NPV and then IRR comes from because these are important when you graduate and then you use it in your work. But with that, I would like to also add the discussion on capital allocation or capital rationing, right? Here, in this case, if your capital is only 5 million, and then you will be given an investment or projects A to F. So what will be your basis to invest on the projects? But you're only limited to five, and these are the investment amounts. So in our case, you would find the biggest, or you would look for the highest um, NPVs if you add the project. So these are the highest ones. This compared to the others. If this one's bad because it's negative, right? And then if you add two plus two, 4 plus 1, 5 million, then you stop from there. That's your solution. You basically say, I would invest my 5 million to the first three projects because this is the one that has the highest net present value. If it's an IRR, then you pick the highest IRR, then you stop by adding the total investment, and then you would select, okay, here's what I would like to choose, or you pick and choose, right? That would make sense. Now, we talked about depreciation that we added, right? And then depreciation, technically you have two types of depreciation. Depreciation that you do for accounting purposes and depreciation for tax purposes. Now, in accounting, you actually use the estimated useful life. If you have $100,000 of fixed asset by 10 years, then you have 10,000 every year until 10 years. That's in accounting. But in finance, we would want to consider the depreciation that's based on tax depreciation for finance purposes. Why? Because tax depreciation is the one that's actually tax deductible. And then we are concerned in finance mostly on cash flow rather than accounting income or accounting related performance indicators, right? So that's one of the things that, so we follow the movement of the cash in finance. Accounting rules has approval method of accounting. Right? In one point in time, if you have taken an auditing class, you would see that the basis of accounting should be accrual method. If it's other than the accrual method, like a cash basis, you need to disclose that in the financial statement, one of those things. Now, the rules of depreciation, the IRS. So we have some students also taking finance course out of CHUP, and some are out of Hawaii, right? In the US side, uh, the depreciation method for tax purposes is through the IRS, and then it's called the makers. So it might not be familiar for those who are in CHUP or the other islands in Micronesia, because there might be no makers, right? In Guam, we adopted the IRS rules, so we actually have makers also, even in Saipan. Makers is actually the modified accelerated cost recovery system. So remember, we say that 10 years. So 1/10 each year multiplied by the asset, that's your depreciation, or the asset amount divided by 10 years, that's your annual depreciation. Makers does not follow a straight line approach. It gives you a it gives you a factor to multiply to the amount that you have, so it would actually depreciate it. It's so basically, I'll show you later on. And then depending on the asset classification, so we have ADS, asset depreciation range, or ADR. And then that's actually depending on which, so for example, us in my company, we have mostly fuel related tanks, um, canopies for the sites and whatnot for the retail sites, underground storage tanks, above storage tanks. Those are oil related. We would have a different asset depreciation range depending on the life of the asset. Then we will be given a different type of number of years. So we would not, this course would not make it complicated to you to actually classify through an ADR for the makers. It will be given to you as a problem, right? In the problem, it will be identified. But just want to make sure that you know that there is a method to it. Here are the makers. So the longest one is actually 39 years for non-residential real property. Then 3 years is the shortest one. And then, so basically that's your estimated useful life, right? But makers for tax purposes. Okay. And then the best way to explain it is actually going through here. Now, there you go. In one of your quiz, I actually gave you the makers, and then I even did a box, right? So you can actually use that. So that's the range. It's 4 years. 4 years because why 4 years? Because it starts on the midpoint. So this 3 year makers is showing 4 years of multiplication, but why? Because you have a midpoint, meaning that you don't anticipate or you don't expect that all your assets are being bought only at the beginning of the year, right? That would be a bit not realistic. You don't buy all your assets on January 1 or beginning of the year. So in reality, it actually happens in between the period of the year. So that's why we have a midpoint or a mid-year conversion. A mid-year conversion convention in the makers built in. That's why you would always see something like the 5 years is actually at the 6th year because you have a small here and a small there. But when you add everything up, it's always going to be 1% or 100% when you think about it. It converts to one, a value of one or 100. So this can be looked at as the first year is 33.3%, something like that. And then on the last year is 7.4%. When you add it up from year 1 to year 4, it becomes 100%. So that's one easy way of looking at makers. So we're going to go show you some of the calculation. Now, don't forget for this illustration on this PowerPoint, blue values are assumed, green values are pulled from the table, and then here it's on the depreciation range 12, right? Like the one that we showed a while ago. And then it's 0.2 to 0.058. Let me just take a look at that one again. Delete. And then we're looking at this one. Oh, sorry. We are looking at this one, okay? 0.058 and then 0.02. So it's for the 5 year makers for our example on the next page. And then it will go all the way to the 6th year, okay? So this is given this is your depreciation base. And then your percentage of depreciation, you multiply it. And once you multiply it, you will get this annual depreciation. If you add everything up, 36,000 in year 1, 57,600 in year 2, all the way to year 6 of 10,440, if you add it up, it's actually 180. So you know 180, which is your depreciation base or your acquisition cost. So it all ties up. So that's your full depreciation. So what did we learn? For tax depreciation, use makers. look at the classification and use the rates on the table from makers to multiply your depreciation base. So simple enough. And then during Trump's time, I remember we sometimes people call it the Trump tax law or the TCJA. TCJA is actually implemented back in 2017. Before 2017, corporate tax rate was at 35%, the highest. Normal is 34%. But TCJA changed it to 21%. At the same time, TCJA or the Trump tax law, as people would normally say it, changed the bonus depreciation. It recalibrated back to 100% of bonus depreciation, which I'll explain later. Now, what happened is that this bonus depreciation is now in 2024, it's now at 60%. Before, for the past few years, it's actually at 100%. So there's a phase out, similar to what if you have your tax classes, right? Our intention right now is to actually discuss it to you, and then so you would have an understanding on how things are being calculated. But like, don't worry, we will explain. I will explain as much as I can. The reason why this is an important is that if you have depending on the year that you have it, there's a bonus depreciation for tax purposes. For example, $100,000 is something that you acquired for tax depreciation, or the 180 that we saw a while ago. You would see that we did it all the way for year 6 in order for it to be fully depreciated. With the 100% bonus depreciation, this 180,000 can be expensed in year 1. You don't need to wait for year 2, year 3, year 4. But that depends on the section 179 election. Then you apply bonus depreciation. I know it might sound complicated, but just wanted to give you an idea for now. But don't worry, it's not on the quiz, but it's important for you to understand it. So I'm going to do a cash flow analysis similar to what we have done before. On the first video, we had this tab, right, on cash flow. We have earnings before depreciation and taxes given. Don't worry about it. Less depreciation, we basically just multiply it with the value that we actually calculated with the 5-year. So don't worry about it also. In the quiz, it will be given. So if you deduct it, this is the earnings before taxes, right? But I wanted to highlight something. Here, you could not have taxes of 25% given also, that rate, because you don't really have any taxes to pay because it's negative. It's a tax. It's the loss, right? You only pay taxes when it's actually taxable income. So I would also calculate 15,600 multiplied by 0.25 is 3,900. I need to deduct it. So my earnings after tax is now reduced to 11,700. And then, of course, the taxes amount here is the one that reduced your earnings before taxes. So your earnings after tax is now this amount. But I need to add back. I need to add back the depreciation similar to how we did it before. Add back. And then now here will be, so technically, when you add it back, let me clear it out. If I add it back, this amount are your cash flow on years 1 to 5. And then year 180, we're following the same problem, right? Is your cash outflow on year 0. So now you can still calculate the net present value, your IRR, your MIRR, and also the payback period. So we just made the calculation of the cash flow a bit more complicated because we wanted to consider the depreciation side. And then if we multiply with the rate, then your net present value is actually 8,014. So I would say do not invest in this one because it returned to a negative. So your what does a negative value on your net present value mean? It means that your equity as a shareholder decreases. You did not create wealth with this investment. With this investment of 180 on year zero, you did not create wealth after year six. You basically reduce your wealth by 8,014 after considering the time value of money and discounting it at 10%. Okay. And then let me just go through some of the other exercises that we have here. This one is actually a calculation of an old equipment and the new equipment. Let me just give you a discussion. It's discussed on the book that you have, but let me just show to you what's different, right? The assumption is that the 180 is the new machine that you're buying, and it actually has depreciation. What's the depreciation of that new equipment? It's actually this one. Remember this? But the assumption on the book is that you will be disposing the old machine because you're buying a new machine. So if you're disposing the old machine, you have depreciation already lined up until the end of the life of that machine. But you're not going to have that as a tax benefit anymore because you're going to dispose it so you can have a new one. So how does it work now? Same way, let's lay out, oops, sorry. Same way, let's lay it out. We're in, it's actually year zero. I have the 180 negative cash outflow. This is an assumption. Proceeds from the old equipment is 37,600. Proceeds means that you're selling it, so it's cash inflow. It should be positive. And then here is the savings before depreciation. We have a new incremental depreciation. Why incremental? I deducted um, I deducted the old, and then I need to take, or I deducted the new, but I need to take out the old. So the amount is actually smaller, right? Compared to before. And then you go to the same calculation and then you just add it up. But when you add up the depreciation, it should be the incremental depreciation. And then you have also a tax benefit here. I'll explain that on the next slide. So the old equipment on this problem, when you read the book, is 120,000. But the new equipment is actually 180. And then you bought it on year one. And then you use that table, and your annual depreciation is actually 62,400. So you need to take this out, this 24,000 and then 38,000, because you're not going to have it anymore. Because you're going to have the 180 now as your basis. So what happens? The sale of the original purchase or the original equipment is 120. The accumulated depreciation, as shown a while ago, is 62,400. And you would tell me, okay, sir, that was a bit too fast. Where's that 62,400 came from? This one. But remember, we're selling it, right? It just incurred 2 years of depreciation. So the net book value of the 120 is now 57,600. But remember, you're going to be selling it for 37,600. So technically, you have a loss of 20,000. Why is it a loss? Your book value is 57,600, but your proceeds is actually 37,600, so you're losing by 20,000 negative. It will mean that that tax loss is deductible. You multiply it by 25%, then it will be a tax deductible amount since it's negative, right? And that's why it is actually here, negative amount. Negative amount because it's a loss, but because it's helping you out save your taxes, we are considering it as a positive amount because it's a savings. I know that's a bit logic wise, like, or when you look at it in math, like, okay, that doesn't make sense. Logic wise, it makes sense. You have a taxable loss. If you have a taxable loss, that's deductible. When you deduct something for tax purposes, you don't pay cash for your taxes because you reduced it. So it's a tax benefit for us together with the proceeds, which is a cash receipt. But I'm investing 180. So now it's 137,400 when you add it up. And then you get the net amount for year 1 to year 5. And then you do a discount. You multiply by 1 over 1 plus I to the nth power. Once you multiply it, then you're adding all of this up will be a net present value of 22,718. I would say go for it because it's actually a positive net present value. So I know it's a lot, but don't worry, your quiz is not that crazy. But we want to make sure that you understand the calculation. So what's our important? The important concept for this week is that understanding how to compute net present value. Go back to the first part of our video, the IRR, and then also the payback period. Those are really solid and then core wherever you go. The modified internal rate of return is basically just recalculating your IRR by reinvesting it. The assumption is to reinvest it at your cost of capital. That's why it's the modified IRR, a variation of the IRR. Easy also to calculate. After that qualitative or quantitative calculation, important part is this. Not one, you should not use the NPV, the IRR, or the payback period by itself. You need to consider all three to look at what's the best invest. Where do you allocate your capital to which investment? Always take a look on all the three. By priority, I would say net present value is something that you would want to see positive. The highest one, that will be a good investment. The IRR should be high enough that it's actually above your WACC, your weighted average cost of capital, or your hurdle rate, or your discount rate. Your payback period has the least priority of all. Why? Because it's only based on an assumption of your cash inflow. It's 5 years, or this one is 6 years, the 180, right? The 180 equipment. You can do a lot to improve the cash inflow process or mechanics or model of the business that your assumptions might be wrong. And then once you actually have actuals, it might be higher. Higher cash inflow to offset your cash outflow on year 0 would mean a shorter payback period. So that's why payback period is an indication, right? So everything is an indication, a key performance indicator, NPV, IRR, and payback period. Consider them all. The quantitative side, consider all of them together, but priority will be NPV, IRR. Then the last one is actually payback period, mostly for indicative purposes. But do not forget to include the qualitative aspect of the business. Which one is the highest business risk? Do I need to invest? For example, this is an investment in a country, right? Do I need to invest this one in China? Is China good right now? Or what about if I go to the Middle East? Might not be a good idea because there are factors, geopolitical and whatnot. So these are the qualitative aspect of running the business through an investment proposal process, which we're doing right now. I know it's a lot this week. Hopefully, we went through it properly with everybody else, with the class. If you do have questions, let me know. By this time, you should think about finance as a future CEO, CFO, and I hope you're looking at it that way. You're putting that CEO or CFO hat because finance is really an interesting topic that later on, when you're either an entrepreneur, a CFO or CEO or COO, you would need to run the numbers on the business case using this topic that we had this week. That's why we put more effort on explaining it. Okay, so I'll post a quiz on the Canvas on Canvas in Canvas. If you have any questions, please do let me know. Message me, and then I'll reply to them. Well, thank you very much, everyone. Have a good weekend. Thank you.